Negative yielding bonds. Let's have a look. Good evening, everyone. Florian Heise here, and welcome to another episode of Heise Says. I've my stein of evening coffee, and I thought tonight we would have a look at this article from the ABC about negative yielding bonds. Now, negative investing in something that will give you a negative return seems fundamentally just wrong. Normal people just can't quite understand it, myself included. Doesn't seem to make sense. But from a psychological perspective, you have to think about it as a signal from the market that people are so concerned with other options that they have to take these negative investments. Well, let's have a read here and have a look about it, because over a third of bonds in the world, if we have a look here at some of them, Switzerland, Germany, Netherlands, Sweden, Denmark, Finland, Japan, Austria, France, Belgium, Ireland, Spain, Portugal, Italy, they've all got negatively yielding bonds. And look at those beautiful interest rate returns there. So let's have a look at this article. This was written by Stephen Leitz from ABC. So, the weirdness in financial markets at the moment seems boundless. In the past 2 weeks, the proliferation of negative yielding bonds has erupted. 30% of the global tradable bond universe is being sold with a guaranteed loss attached to the coupon. A guaranteed loss. That's an eye-watering US $16.7 trillion worth, 25 in Australian. So 25 trillion Australian dollars worth of bonds are being traded at a guaranteed loss. Wow. The bizarre concept that the safest bet in the market, holding a bond to maturity, costs you money, mutated out of the global financial crisis as several notable European central banks kept cutting interest rates all the way below zero. So here you go. This is it just shows you the issues in this whole monetary system. It really does. It's this whole fiat system where they're just, printing and unprinting and negative, and it's getting frustrating. The more and more I'm learning about this, the more frustrating it's getting. The more I seem to think our entire economy in some way or another is a huge Ponzi scheme of debt, where they just want us all to keep, running in those little hamster cages. Come on, you proles, work. The Bank of Japan joined in 5 years ago, and the new financial black hole started to expand. At first sucking in billions, now trillions, from large financial institutions such as pension funds and insurers. Well, it will be interesting to see, particularly with what's happening with GE at the moment, what's all come out of General Electric with their pension funds and the insurances they provide. This is all very concerning, isn't it? In effect, creditors willingly enter a deal with debitors knowing they're going to get burned. It turns the whole financial world on its head. Just think about what's happening here. And, we've got a monetary system based on the Chicago School of Economics. How would any rational actors make these decisions? And, it just screams to show that the Austrian school is right. Just imagine a bank giving you a mortgage and saying, don't worry about the repayments, we'll pick up the tab. Yeah, that's never going to happen, guys. That's never going to happen. The quantum of negative yielding debt doubled to 14 trillion in the first half of 2019. Its growth now appears to be hitting warp speed. So the market value of negative yielding bonds as a percentage of global bonds up to 30%, so nearly a third, heading up. That's just crazy. I'd love to see this chart expanded to the last GFC. Germany, Denmark, Netherlands, and Finland now all have bonds across the spectrum, 1 year to 10-year bonds, trading with negative yields. The likes of Sweden, France, and Japan are not far off being totally negative too. US 10-year yields remain in positive territory, but only just, and it's trekking down, as is the yield on Australian 10-year Commonwealth government bonds. US Treasury bonds have just inverted, with yields on long-term 10-year bonds falling below 2-year returns, causing all sorts of market connipitions and raising fears of a recession around the corner. That's put more pressure on the Fed to cut and cut again. Well, of course. I mean, God. Oh boy. We're really just heading. This is going to be a completely insane global recession, I think. We're going to see things happening that have not happened in the past. A cut here and a cut there. A decent economic contraction and another 16 trillion worth of US bonds is in danger of sinking into negative yield territory. Given the prospect for global economies are sagging and there's hardly a flicker of inflation to be spotted in the gloom, it's hard to see how things don't become more negative. Well, yeah, yes it is. It is hard to see how things don't become more negative. I do not understand how our leaders here in Australia can be arguing that everything's fine in Australia when, we're depending on the Chinese domestic market to prop us up, because, they are a big portion of our export market. 30% or 35%? 35% of our exports go to China. Guys, 35 go to China. They're expecting it to prop it up. The domestic section to prop up our economy. It doesn't make sense. That's more hope. That's hoping. That's not planning. But then again, I mean, it's an illusion to think that there's going to be any difference in who's leading us, that we can actually manipulate the market. All we can do is put off the inevitable. That's all what this monetary manipulation does. And are we going to start seeing it all fall apart? Let me know what you think in the comments. So back to the article. Should we be worried? Well, yes. It might be the arcane and barely comprehensible world of global finance, but there are troubling precedents for the explosive growth of things that seem to make little financial sense to an ordinary punter. Abstract ideas like collateralized debt obligations and contracts for difference bubbles away out of sight, getting bigger and bigger, as they did happily until late 2007. It's not a problem until suddenly it is. The artifice is exposed as unsustainable, and the amount of money that has been sucked in is so huge that the whole edifice tumbles down. Well, yes. Yeah, that's what I think we're going to start seeing. The negative bond yield phenomenon has pretty well destroyed the time value of money as the core of finance theory. As Hong Kong-based Macquarie strategist Victor Chevets wrote recently, this has serious consequences. The destruction of the cost of money not only interferes with credit cycles, but also keeps zombies alive. It encourages speculation and discourages productive investment, he said. It spurs a race to the bottom with beggar thy neighbour strategies as nations compete to maximize returns from ever-declining utility of debt. Oh boy, here we go. As long as monetary policies dominate, inequalities will continue widening. Eventually, most societies will simply blow up. Mr. Shivat's disturbing endgame. Yeah, I think so. I think we're starting to see that happening. Because, a gentleman left a comment saying, I only focus on the negative. And I replied that, well, you probably haven't seen anything positive I've discussed because the algorithm doesn't push it out, because no one likes it, no one clicks on it, no one's concerned about it, and that he's got faith in the Liberal Party to lead us through this. And I think it's just blindly placed. I don't think there's any difference between the two, to be quite honest. At this point, I just think it'll probably delay it a little bit. Hopefully we'll get less taxes with Liberals and Labor, but we'll see. So distortion. Sovereign bonds traditionally provided the bedrock investment and risks are priced off. When they crumble, everything gets thrown out of whack. JP Morgan's Nicholas P. says that the asset allocation of big investors like pension funds and insurance companies who are obliged to buy massive licks of sovereign bonds are being damaged by the negative rates. And things will get worse if the universe of negative yielding bonds expands much further. But if they bought the bonds years ago, they should be fine, shouldn't they? Or are they selling them? Will negative rates force pension funds and insurance companies or other investors that dislike negative rates to move to equities? Mr. P asked. Or will pension funds and insurance companies hoover everything with positive yields in the fixed income space, including alternatives such as private debt, and avoid equity asset classes? I mean, here we go, 10-year government bonds, Australia, Germany, US, Japan. Trending down, guys. Trending down, not looking good, not looking confident, is it? So who are the winners? There are ways to make money on negative yields. Play pass the parcel, selling the bond for a higher price as the yield sinks lower. This has a limited lifespan and is very dangerous when the music stops. Some sophisticated traders can borrow at one of the yield curves and lend at the other, picking up a few basis points profit along the way. Trades can be carried across currencies, again picking up a few points of margin here and there. That's, yeah. Superficially, governments issuing negative should be laughing. Germany, for instance, is being handsomely subsidized for decades to come by investors prepared to pay around a 0.5% premium for the privilege of buying bonds. Normally, those investors would expect a fairly solid, virtually risk-free profit. The only problem is Germany is not laughing. It is in recession, and there's no signs that easy money is being recycled back into the economy. Well, there you go. I mean, remember, Germany is one of the biggest economies in the world. I think it's the third biggest at the moment. What does that tell you? How's the EU going? What'll happen at the end of the month when Brexit kicks off? What's that going to do? That'll be interesting to see. What do you think, guys? Do you think Boris will pull it off? Do you think he'll get out? Do you think he'll get out? What'll that do to the price of the euro and the pound? Or gold and silver, more interesting. The big end of town is lapping it up too. Banks are the exception, with the borrow short, lend long margins being squeezed. The main beneficiaries of negative rates have been large corporates, which have seen a collapse to their interest expenses, as well as private equity companies that are able to lever by even more than in previous cycles to amplify profits, he said. And the losers. So here we go. So far, the losers are relatively contained and predictably at the small end of town. Mr. P said the squeeze on pension and superannuation funds, as well as insurers, has seen benefits reduced and or demand for contributions increased. The overall impact is that lower yields can induce households to save even more in the future, he said. Well, there you are. Mr. P argues, while there may have been some positive impacts, like initially keeping rates in very negative territory for prolonged periods, or diving them deeper into negative territory could unleash more unintended consequences than benefits. Well, yeah, it could. This isn't natural. This is not natural. This is a sign of a zombie dead economy being propped up to life with electricity. It's a Frankenstein. Increasingly, negative rates are viewed more as a policy mistake rather than stimulus, and create a sense of an abnormal and uncertain environment that damages not only banks but also consumer and business confidence. Well, yes, I mean, our consumer confidence here in Australia, it jumped up. It certainly jumped up in the last Westpac Melbourne Institute survey. But I suspect a lot of that was to do with the tax payments. And since the major thing punching that up was time to buy household items, yeah, I'd bet a card on that one. So, the sense of abnormality and uncertainty likely makes businesses and consumers less rather than more keen to spend, and banks more rather than less averse to taking risks and extending credit to the real economy. Yeah. But by far, the most alarming problem is likely to be just as it was in the lead up to the GFC, mispriced risks and vast amounts of capital shuffling around looking for more substantial returns. The bets get bigger and then boom, it's all gone. So red flags. Despite a veritable bunting of red warning flags on display, the market through Friday was as good a day as any to get back to buying risk. Inverted yield curves, whatever. Chinese industrial output hitting 17-year low, not to worry. Trade war, so what? European companies slipping into earnings recession, priced it in. Germany in an actual recession, yawn. Well, there you go. Yeah. I mean, the thing is, the market can remain, unreasonable longer than you can remain solvent in some regards. The S&P 500 rose by 1.5% in the closing session, but still ended in the red for the week. it was a similar story in Europe. The ASX had an ugly time of late, losing almost 3% for the week and down more than 6% since its record high of late last month. So puzzling results. The first take on the ASX results season so far range from puzzling to messy. Discretionary retailers such as JB Hi-Fi, Super Retail Group, have delivered some of the most upbeat, surprising, oblivious to talk of retail recession in the commentary from NAB's business survey and the South African owners of the David Jones chain. In contrast, a couple of their listed landlords, JPT and Vicinity Centres, owners of the sprawling Chadstone complex, were muttering darkly about challenging conditions. The banks kept on their mantra about intense mortgage market competition, a euphemism for no one's borrowing, while real estate portal REA talked about buyer interest in its site bouncing back. But JP Morgan said, with about a third of the stock it covered having dropped results, an underwhelming 18% of companies have beaten expectations, while 25% have fallen short. Only 9% have seen their earnings forecasts upgraded. That's a barrage of results this week. There's a barrage of results this week, including BHP, BlueScope, Qantas, and Medibank Private. So it's a quiet week ahead. Data-wise, it's a fairly quiet week. A collection of purchasing management surveys, PMIs, is expected to show the pulse of the world's industry heartland continuing to slow. Well, yes. The world's most powerful central banks have their annual get-together in the back blocks of Wyoming. Host and Federal Reserve Chairman Jeremy Powell speaks on Friday, while the RBA's Philip Lowe steps up to lectern on Saturday. The G7 leaders are heading to France's sunny southwest in Biarritz for a 3-day summit. Could this be just the stage for new British Prime Minister Boris Johnson to finally tell the world what's going on with Brexit? Whatever the case, it's going to be entertaining. So here we go, what the results are. So yes, it will be interesting to see in the lead up to the end of the month. I think Brexit's going to be a big deal if it happens, or if it doesn't. I think it definitely will be. What do you think, guys? What do you think? Do you think these negative yielding bonds around the world, what are they telling us? What are they telling us about what's happening in the economy? Doesn't seem natural. Seems very concerning. It really does. Could that be? A lot of people are saying that these negative yielding bonds are the result. It's what's forcing the inversion in the US bonds, because it's pushing more money into that market. That's definitely something to consider. But another thing is how many of them are. And I mean, can negative interest rates, can deep negative interest rates like the IMF are talking about, can that potentially make any difference to stimulate an economy anymore? Is it possible? Is it just going to delay the inevitable? Well, let me know what you think, guys. Please like, share, and subscribe, and I'll see you all again later. Take care. Thanks for watching.